Hi group, it's Mrs. Schaus. I wanted to talk to you a little bit today about the use of credit cards. The first thing I think you need to ask yourself is why is it that you want a credit card? What are your intentions for the way that you plan to use it? We really should be thoughtful about avoiding excessive debt because that can be a result of improper use of a credit card. If we're telling ourselves it's going to be used as a way to develop our credit, then we have to make sure that we're really using it responsibly if it's what we choose to do. It is not the only way to develop credit. You certainly can build your credit by getting a small loan for a used vehicle or something like that and paying those payments on time and paying in full. When you're done paying off that loan, perhaps you get another small loan. So you're showing a behavior of being able to make those payments on time. With credit cards, we can still build credit, but we have to be very careful again to avoid that debt piece like I was talking about. Many folks will say, I want to get a credit card because I could have it for emergencies. But emergencies don't mean pizza runs or things like that. So we have to be really careful. The other thing is we want to have as much money stay in our pocket and out of the pocket of the credit card companies. So there's some terminology here that we want to address. But also these are things that we should sometimes be thinking about when we're looking for and making a selection on what type of credit card that we would like. First of all, some credit cards do have, sorry about the lighting there, some cards do have an annual fee. That means there is a yearly fee just for having that card. Perhaps we want to avoid that. But there are other kinds of fees. And probably almost any card has some of these types of fees. You just have to look at what the fees are and compare them to try to find the best situation that you can. Often if we want a cash advance, meaning instead of buying something, we need cash in our pocket, then we maybe could have a fee associated with that. So again, you want to look at what that amount actually is. One card it might be $25, and another it might be $35, something to consider. If you go over the limit meaning when you get a credit card, there's a maximum amount that you're allowed to borrow. If you use it well, you certainly could apply to have that limit be increased. But again, how much do you really want to have as a balance on your card? And they're going to charge you a fee if you go beyond the limit. So if you have a card with a relatively low balance, let's say $1,000, and then you make a purchase and it takes you over that limit, again, they're going to assess some type of fee. It could be $25, $35. It just depends on the card. And they're going to do that every single time that you go over. So again, increasing the amount out of pocket, but also increasing your balance. And once your balance is increased, then in subsequent months, you could be paying interest even on these fees. All right, we talked about grace period before, is the amount of time before interest starts accumulating. And that really works not only in the credit card sense, but also really for installment loans. There could also be maintenance fees, or sometimes there are transfer balance fees. So this just says other fees, but it could be a transfer balance. If you have one credit card and you want to get rid of it, and so you put the balance over onto another card, there could be a fee for that. There could be a fee for making your payment late. So you have to really look into each card and compare when you're trying to decide which credit card you might like to select if you're planning to get one. I'm going to turn back a page or so here. I wanted to address this whole idea of a low introductory rate. Sometimes they call that a teaser rate. Many credit card companies will make offers like 0% APR for the first 6 months. What they're trying to do is to get you used to using credit, right? They want you to have what we call a taste of credit. And then you can, get that, new sweater and that new pair of shoes, and you can go, out to dinner with friends, or, can do all these things that you then put on a credit card, and you're going to pay them additional monies for borrowing their money, but also maybe even some additional fees. And they like to collect that money. That's how they make sort of their living. But we don't want to support the credit card companies. We'd like to keep our own money in our own pocket. So be on the look out for those low introductory rates, and know that that's what they're doing, is trying to lure you in. Also, sometimes it can even be a little confusing. Maybe you'll get an envelope with an offer that says, apply for this particular credit card, and the periodic rate is only 1.5%. And you might go, 1.5%? That sounds like, a really low interest rate. But let me share this little piece with you. If your periodic rate is 1.5%, then your APR is 1.5 times 12. Periodic rate means monthly rate. So if we multiply by 12, that's 18%. Not good. Now, I can say that that's not good, but let me share with you folks some information about Americans and the use of credit cards. First of all, the average credit card balance in the U.S. is $6,194, and that was based on a report from Experian, which is one of our 3 credit reporting agencies, in 2019. The minimum monthly payment, now this isn't reported by Experian, but still a good resource that I was addressing here. Minimum monthly payment was about $123.88. The average APR, so this is the one that I find really interesting. Average APR between 17 and 20.5%. For folks with excellent credit, about 13%, and those with fair to maybe getting borderline poor, more like 23 to 24%. Now, those are super high interest rate. I mean, even the excellent, the 13%, is still pretty high, depending on especially the balance that you might carry on your card. Hopefully not something like this. But to have a balance like this and carry a rate of 23 or 24%, you're going to be paying a lot of money every single month in interest to support, whatever credit card company. And I just really hate to see that kind of thing happen. So for emergencies, yes, but again, what constitutes an emergency? Okay. Some folks also use credit cards so that they don't have to, carry cash or something like that, and they seek out cards that have some sort of membership benefit, right? They earn points back or earn frequent flyer miles or whatever kinds of things they might earn. And yes, again, if you use those appropriately, you pay the balance down monthly, so that you don't have some sort of high balance that you're carrying on them all the time, that could be a reasonable way to use that type of credit. But we do have to be very careful and very thoughtful, or we can get ourselves into a situation where we really have a struggle financially because of it. Always looked for fixed interest rates. Now again, this is really your module book talking about not only credit card borrowing, but also those installment loans that we looked at. Fixed interest rates versus variable kind of reminds me of, normally maybe for a vehicle you'd have a fixed interest rate, but you might have a variable rate like on a mortgage or something like that. What I really want you to understand about credit cards is that even if they offer you a particular interest rate, let's say 18%, right? So they offer you 18% APR, and now you're a few months into using your credit card and you're making your payments on time and things are going well, and all of a sudden you miss a payment. Maybe you lost your job, or you got injured or something like that, so you couldn't work for a spell, and now you can't make your payment. And even though maybe a month or so down the line you're able to make your payment again, you have now entered this position of what they call universal default, and they can, if you look at the contract that you probably signed with the insurance or the credit card company, they would be able to increase your interest rate. And so maybe that 18% now jumps to 22%, right? And you think, well, that's not what I signed up for. But be careful of that fine print. Perhaps it is what you signed up for, okay? And finally, the one other thing that I want to address with you folks in your module book here is the idea of the 5 C's of credit. So these, again, do apply to any type of credit, so not just the credit card, but also the installment loan that we've already been considering. But these are basically the items that are used to determine your credit worthiness. Capital. So first of all, the idea of capital is that you have some things of value, in particular cash on hand, right? So if you are applying for a loan and you're able to show that you do have a bank account with a certain balance, it might make it look as though, hey, this is a person kind of that's being responsible with their funds, has some sort of in storage, and looks like they might be a better bet on someone I might want to loan money to. Move this piece off here. There we go. All right, capacity. Your capacity really is like your capacity or ability to be able to work. So they want to be able to see a history of steady employment. And when you're younger, maybe an income that's continuing to increase as you're building into your career. Okay. Character. Now, it does talk about the credit report here, which we did address previously. I'll come back to that in just a minute. But that is sort of where they would get information about your character. They want to see how you've used credit in the past. So they look at your credit report and your credit score. Credit score gives them some information, sort of about a ranking, essentially. Do you have excellent or good or fair or poor credit? But also it gives them some detail. So instead of just a score, it might tell them things like, what is your income to debt ratio? Like you might be making your payments currently on time, and you may have been using credit well in the past, but maybe you have a lot of different loans for the amount of money you make. So it provides them with more specific information like that, okay? Additionally, it would include information about late payments that are made or non-payment, and also even shares information about when accounts are closed or when an installment loan is paid in full. So lots of more detailed information they can get from that credit report. All right, collateral. Collateral is something that you have in your possession that you could use to give back to the lender if you're unable to make payments. Now, trust me, they don't want the collateral back. For example, if you purchase an automobile with a loan, the automobile itself can be collateral. So that way, if you don't make your payments, the lender could take the vehicle back from you. They would prefer to have your funds. Trust me on that one. But it is better for them to at least get some compensation than to, basically end up having you default on a loan and then they're just out the whole thing. If you don't have collateral on a loan, typically the interest rate will be higher. And this last one that I hadn't highlighted yet here is conditions. Okay? And it says, lenders may be more lenient about past credit troubles if you can prove you're moving past a bad experience. So it talks about identity theft or unemployment as potential, things that could happen. If you have always been someone who uses your credit wisely and then you lose your job, it might be the case that you can't make a payment or two. But then if you show yourself as getting back on track, within your credit report, you can attach a statement. And if you explain that, this condition might be something that they would take into consideration. It doesn't mean that if you provide a reason that that's necessarily sufficient. And that you'll definitely be, guaranteed the use of credit or a certain interest rate or anything of that fashion, but it does mean that it's something that they may take into consideration. Okay, so I'm just sharing with you some of the information about, again, use of credit and, in part, use of credit card. A credit card is a way to borrow money in a revolving sense, okay? This week, we're also taking a look at some of our calculations for credit card usage. I just wanted to have a chance to share out some of that information in your module book. And you should be reading your module book and looking for these keywords and concepts so that as we get ready to move into our next assessment, that we would not only have the calculations down, but also have asked questions and clarified anything that sort of seems important or interesting to us in our reading material. I'll talk to you folks soon. Have a good day.